Hello everyone, this is Arun Kochi. The topic I have chosen is capital structure. Capital structure it means composition of long-term source of finance. It means that we have a certain combination of debt, equity, and preferred shareholders so that it has to increase the value of the firm and it has to maintain optimum capital structure. Optimum capital structure it means that the cost of capital is minimum and the value of the firm is maximum. So this when it means that when the expectations of the investors is low, then the value of the firm increases. It means it will increase the market share, the price of the market share. Yeah. In capital structure, there are four approaches. First one is net income approach. Second is net operating income approach. Then Modigliani Miller approach. Then traditional approach. This net income approach is proposed with a Durand. As every approach will have some drawbacks and loopholes. After release of this approach, Durant realized the drawbacks and the loopholes in the net income approach. Then he proposed another approach called net operating income approach. It means that net operating income approach and net income approach both are proposed by the Durant only. And next one is Modigliani Miller approach. This approach is just an extension of the net operating income approach. It just extends the topic of the net income approach. Then comes traditional approach. Yeah, the first one is net income approach. Yeah, as I told you that this approach is proposed by the Durand. This approach states that capital structure will affect the value of the firm. Means that when the debt is cheaper source of finance, when more and more debt is introduced into the company, the cost of capital will decreases and the value of the firm will increases. It means that it states the based assumption that debt is cheaper source of finance, and when even though more debt is brought into the company, the expectations of the debenture holders will not increase, and also expectations of the equity shareholders will not increase. This is based on these assumptions, and also it is based on one another assumption called there are no tax effects. So but we all know that raising debt is not an easy in practical world, and also that when more debt is brought into the company, the risk will be higher. So equity shareholders as well as debt holders will expect high interest rates. Yeah, these are some drawbacks in the net income approach. But so that's why Durand proposed another approach called net operating income approach. Yeah, it is just an operating income approach. It is just an opposite to the net income approach. Just an opposite net income approach. It states that capital structure will not affect the value of the firm. Means that, as I told you, that debt is cheaper source of finance. More and more debt is brought into the company. The value of the firm will increase. Cost of capital will decrease. But at the same time, when the expectations of the shareholders, equity shareholders, and debt shareholders increases, the same capital cost of capital and the it will increases, and the value of the firm decreases. So when these two when these two effects we combine together, the cost of capital will bring back to the same as before when these two effects is brought together. Yeah, and these approaches also said based on assumption that there are no tax effects. Then comes from Modigliani Miller approach. As the name itself says that this approach is proposed by the Modigliani Miller. This is same as net income approach. It also states that capital structure will not affect the value of the firm, but only when there are no tax effects. But when there are tax effects, a company which have more debt will have a slight higher value because we have some tax benefits on interest and on paying interest, right? That's well. When more debt is brought, we have to pay more interest, so we'll get more tax benefits. So if you save more taxes, then it will be brought, then it will add back to the capital of the company. Then the value of the firm automatically increases. So that's why he says that when there are tax effects, a company which have more debt will have slightly higher value than the company will have high equity. So this is the, and we can raise funds from the raise from different combinations such as equity and debt, equity and preferential orders, equity, preferential orders and debt, and only equity and only preferential orders. But we cannot raise funds only from the debt holders. So yeah, that's it. And a company which have only equity, a company which can raise funds only from the equity shareholders, it is called unlevered company. Unlevered company means it does not have more flexibility. It has to raise funds only from the particular source, that is equity. It cannot raise funds from other sources. And also a company which raise funds from the equity and the debt, it is called levered company. It means that it has more flexibility than the unlevered company. It can raise funds from the equity, and it can raise funds from the debt, and it can raise from the equity, raise funds from the both equity and debt also. Yeah, this all is based on the assumption that Modigliani and Miller approach this propose this approach based on the assumption that every investor is arbitrary. Arbitrary means a person who look for more options, whether in buying, whether in selling. Yeah, thank you. This is the